Did you order some kegs of beer?
No.
Well, there's a fella in a beer truck out on the street that says you did.
Oh, really?
Yeah.
Just a sec.
Hello again everyone, I hope you're all doing really well. Today I'm going to revisit one of our fallen friends, that being ContextLogic, aka Wish. Now when I talk about friends, right now Wish and I, and I'm sure many of you out there, are going through a phase in our friendship where Wish, a relatively new kid at school, had been promising some kick-ass party because their parents were away.
You guys know anything about a party here tonight?
No, sir.
They promised free kegs, a swimming pool, and all the babes from school were going to be there, only to tell you the bad news at the very last minute that their parents were not going away and the party wouldn't be happening.
Yeah.
Were you going to have a party here tonight, son?
I don't know what that was all about.
Start unpacking. We're not going anywhere.
Of course, that party I'm talking about were the June quarter results that ContextLogic just released. Now, my last update for the stock came the day before ContextLogic released these results, in which I reviewed analyst expectations. In response to those expectations, ContextLogic released a dismal result which saw revenue fall 6% year over year to $656 million, missing estimates by $67 million and making it its first quarter of declining sales since its IPO. Furthermore, ContextLogic's net loss widened from $11 million to $111 million compared to the same period last year. Overall, they posted an 18-cent per share loss, which was 4 cents worse than had been expected, though still an improvement from the loss in quarter two. So what I want to do is a bit of a review of how the stock has fared since then, use a bit of a technical analysis to try and find a decent trading range and undertake a bit of a post-mortem on some of the results, as well as comment on the general outlook for the stock and the company at this stage. But before I do that, I want to quickly remind new viewers here that I'm planning on setting my channel up as a social enterprise going forward, meaning that I want to use the money raised from YouTube advertising to support a range of good causes that I feel passionate about. I think it's a unique way to make a difference. Rather than people donating money, people are supporting the causes simply by watching videos like this one. So I want to encourage people to sign up to the channel and support this unique initiative. We're getting close to that 1,000 sub mark now, so thank you to everyone who has joined up so far. With that out of the way, let's get into this ContextLogic stock update. So diving straight into the technical analysis for the stock, we can see what has happened to the stock basically over the last 1.5 weeks, leading up to and following the release of the results. One of the reasons I wanted to do this video is because nobody seems to be covering the stock since the earnings report, and it's possibly because of the sobering effect the results had. Basically, the stock fell off a cliff, dropping over 30% when trading resumed following the release of the results. There was a bit of an attempt at a rally for the stock. However, given the swath of bad news coming out at the moment, particularly in America, there has been weaker than expected economic data come out this week, including declines in retail spending, as well as the state of limbo the crisis in Afghanistan has probably had on markets in general. So this means the stock has come under further pressure due to wider market forces, making it harder for it to rise up at all following the stock's initial sharp decline following the release of the June quarter results. Zooming in, since the results release, the stock has actually traded in a relatively flat pattern. That was of course until Thursday's trade. Generally though, this makes me think we can perhaps find a potential trading range, and based on this chart, this is what I've come up with. So prior to Thursday's general market drop-off, the stock seemed to have found some higher resistance around the $7.05 mark, a level which had been tested several times during the week. This makes me think that if the stock can open with some momentum during Friday's trade and is able to push beyond the $6.40 mark, represented by the higher of the two red lines, a point which it struggled during Thursday to rise back above, then the stock might be able to find a new lower level of safety around the $6.80 mark and have an upper resistance mark of $7.05, giving it a new trading range to potentially target in the short term. Based on the low range of the RSI from Thursday and the narrowing Bollinger Bands, we could indeed be set for a bit of a breakout for the stock during Friday's trade, and if anything, likely in an upward direction. Of course, however, given the nature of the current news cycle, it is not one that has been friendly for somewhat riskier growth stocks such as Wish, so I wouldn't be betting on it with 100% surety. Leading into Wish's June quarter results, I can't believe I didn't see the drop-off in sales coming earlier. Given the nature of how the world economy has been generally opening up again, there has been a slight move away from online shopping and a return to shopping in store. This was revealed in Amazon's recent numbers, but is perhaps more pronounced for a company like Wish. Wish is like an online $2 discount shop, the likes of which basically could not operate during lockdowns. Now that lockdowns have lifted and the discount stores are able to trade at normal capacities, there is a greater availability for cheaper consumer goods without the extensive periods of wait time for shipping synonymous with buying from Wish. So the return to bricks and mortar shops is likely to hurt an online platform like Wish, given that it will possibly have more trouble establishing brand loyalty than, say, a bigger online retailer such as Amazon, especially when given the different nature of what is on offer and the shorter history and less established regular customer base that ContextLogic has. Also, when you factor in typical shipping times for orders through Wish and the low-cost nature of items, it will likely mean a greater portion of customers are going to resume shopping at local bricks and mortar discount shop options than more established premium online retailers. In fact, it has come out that consumers tend to have greater loyalty to businesses that offer both online and bricks and mortar shops rather than pure play online retailers. So in general, in the current climate, there are a fair few barriers that Wish is up against. So keeping this in mind, I want to have a look at their recent financial statements and make the case for why things may not be as bad as they may seem for ContextLogic. So firstly, and this was the headline, that ContextLogic had missed earnings and had seen a decline in revenue, notching up $656 million in revenue for the quarter, which was $66 million below expectations. However, it is worth pointing out that ever since going public, ContextLogic has actually missed analyst expectations in terms of earnings, which may mean the analysts who are making these projections need to recalibrate the way they are approaching the company, although it could still also mean poor performance from the company. Adding to that, it's a no-brainer that the middle two quarters of the year for ContextLogic and retail in general tend to be quieter, those being the June and September quarters. When you combine this with the fact that there has been a greater move back to bricks and mortar businesses, and as we just discussed, the unique customer dilemma this presents companies like ContextLogic, it's not at all totally surprising that they do miss their earnings in this particular instance. What is good news for the company, however, is that net income and earnings per share, while still in the negative territory, show a continued improvement for the company. They are becoming more profitable, and the big reason behind that is selling and general admin expenses have been coming right down. So this is a very pleasing sign for the company despite missing revenue expectations. Looking at the various streams of revenue, we can see that declines do occur for the business in terms of marketplace revenue and core marketplace revenue, which is a reflection of a slowing down in sales, which isn't a good sign for the company. However, the company did see very pleasing growth for their product boost, and perhaps more significantly in their logistics arm of the business, which has been a focus for ContextLogic this year and is the company's most strategic attempt at diversifying sources of revenue. So that is a pleasing result for the company, with a 200% improvement when comparing this first half year versus last year. Switching to some extracts now from the interim balance sheet. While there has been a general shrinking in terms of total assets and equity for the company, which aren't on the screen at present, there has been a continued improvement to the level of current and total liabilities. By reducing particularly current liabilities, the company will be able to more likely become profitable, and this was well reflected in the latest statements for the June quarter. Despite having a drop in sales, ContextLogic actually were closer to profitability than they have ever been since going public. Hopefully this is a trend that shows up in the September quarter, as well as when we move into the more profitable December quarter. So, in conclusion, while the decline in revenue has been a particularly sore point for ContextLogic from their June quarter earnings, I think the improvement in the amount of liabilities they are carrying, the improved gross profit margins, and the continued strong performance of their logistics revenue have been good signs for the business. I'm personally still quite keen on the stock and have been continuing to expand my overall holding, and will continue to do so going forward, especially now because to me the stock seems to be really discounted at the current price levels. Anyway, what do you guys think? Are you still long on Wish? Do you think the decline in revenue is a sign of what's to come in the near future? Let me know in the comments below. If you would like to see more ContextLogic or other stock related updates, I encourage you to subscribe to the channel. Like I mentioned at the start, by doing so you are helping to support the social enterprise initiative I am hoping to turn the channel into in the near future, where just by watching videos people are helping to support good causes at no financial cost. So I encourage you to be a part of all that. It's an opportunity to use the power of YouTube for a social good. Anyway, until next time guys, may the markets trade in your favour. Cheers.